you take 10 trades in a month, all using the exact same strategy and setup. Some play out, some don't. Why is it that the trades that play out actually go on to run? It's most likely because you're trading in line with higher time frame context and you've completed or inadvertently completed the right higher time frame analysis. But the problem is most traders don't do this. They just simply trade price action. So what I'm going to show you today is how to use higher time frame analysis, combining multiple time frames to take much higher probability trades. And I'm going to look at 2.6 hour winner that I hit on CAD JPY towards the end of last year. So let's take this away and start with price action. So we're on the 12-hour time frame, and we can see that price is doing its thing. It's very hard to make sense of what this is doing without understanding higher time frame candles. So the first thing I'm going to do is overlay a monthly candle behind my price action, so I can start to get a sense as to what's happening in relation to the monthly candle on the 12-hour time frame. And I can see straight away that the initial bullish price action here came off the liquidation or the false breakout below these equal lows. So we have a monthly candle closing right here. Price broke out below and then shifted structure and aggressively targeted the highs. So I already know that the external range liquidity at both ends of this candle range has been purged. So I can take away the monthly candle and I just want to look at what's happening on the weekly candle. So what we can see is that price shifted extremely bearish into those monthly lows. We got the liquidation and then we saw that shift. So you've got the structure shift right here. But then what we see is that price raids the external liquidity at these highs and starts to retrace. But it does so leaving a weekly order block. So from this high right here, we can draw on our weekly order block. So I'm even just going to write weekly there so that we can see this. Because we had a bearish weekly candle followed by a bullish weekly candle. So we had that last sell to buy. We also have the highs of the previous monthly candle, as we just saw, already liquidated, as well as the lows. So there isn't much reason for price to want to retrace further than this. But when we get the actual weekly candle closure right here, we have a very high confluence, or we can make a very solid assumption that price is going to continue higher. And the reason for this is we have bearish weekly candle creating a weekly order block, and we also have a liquidation of this weekly low. So I'll just draw that on, and you can see we have bullish weekly candle creating bearish the weekly order block. We have price retracing into the order block, so respecting highs, trading through lows. We then get this price leg here, which raids below the weekly low, and then we get a close. And at this exact point here, we get the closure of the weekly candle. So we have a closed weekly candle, which has closed inside of its previous candle's range. We're also coming off a key level, which is the weekly order block. So we have very high probability that we're going to trade back towards the high of the previous candle, which is the monthly candle. Given that price has already liquidated the monthly high, if I just bring this back, we can also assume that price wants to go beyond this level, because if it wanted to reverse and continue lower, it wouldn't have shown this structure shift. So at the opening of the new weekly candle, we can simply track the internal range liquidity in our price legs to take the trade. And let's just do that. So if we zoom in, we can see an order flow shift right here, whereby we had a bearish order block, and I can just mark that with my 12-hour order block. So price trades into the order block. It actually liquidates the high, fails to go lower, but what does it do? It trades into a fair value gap, a bullish fair value gap, an imbalance in price, which I can mark right here. And I'll make that green to show that this is bullish price action. What we also have is a bullish 12-hour order block. So right here, so we have, to make this explicit, price trading down, respecting internal range liquidity on this bearish run. We have aggressive run in with a fair value gap and order block. Price trades straight through the fair value gap into the new imbalance in price, which we can take a trade from because we have bearish weekly order block, weekly liquidation, and highs to target, and we can just take that trade right there, which is exactly what I did. So you place your long at the fair value gap, or you can take the discount of the range, stop at the low, and then we just target the high. And as you see, that's a 2.6 hour trade that plays out within just over a week's worth of price action. This is extremely low stress trading, it's swing trading, and it's just using higher time frame candle closures, lower time frame price action to time swing trades in the market. So let's look at a tiny bit of theory here. So what is higher time frame analysis? Higher time frame analysis is the process of using your higher time frames to determine your higher time frame bias for price. So irrespective of whether you're swing trading, day trading, scalping, you need to always combine higher time frame candle closures, so in my case, monthly, weekly, 2 weekly candle closures, with your lower time frame price action to make sense of when entries that present themselves are the right entries to take or not take. Most traders just open their charts, look at their trading timeline, start hunting setups. They see order blocks, fair value gaps. They have no idea if they're trading in line with their weekly higher time frame or their monthly higher time frame. Why this matters: if you trade with higher time frames, you will take higher probability trades, which will mean you'll be a better trader and you'll win much more often. So if we just zoom out of this, I'm going to show you how this also does not work. So if we see here, if I just take this away and we just look at price action, so we can see we also have a liquidation of this weekly low right here. I'll mark that in the same color for clarity. And then we also have price running down, trying to go lower, and then shifting bullish. So we have our weekly liquidation, we have a structure shift, we have internal range liquidity right here. As you can see, there is a bullish fair value gap at this point right here. So why is it that this trade does not sting in and then continue higher? Why is it that this works and this doesn't? And the reason is the monthly candle. If we just bring this back, so at this point here, we have already raided below the monthly low. We've liquidated the previous monthly candle. However, when you take this structure shift, you can see we still have a weekly low that is exposed. And if you look at the prior candle right here, the prior monthly candle, it liquidated or it manipulated above this candle's high. So even though we're seeing these structure shifts, we cannot place any counter trend trades because at this stage, the bias for price is still the lows in the market, which price is trading towards, because we are at the moment liquidating or purging the external range candle here, the external range liquidity, and we're targeting the opposing end of this candle's range. However, as soon as we get this sweep and structure shift, we have brand new context for longs. And then it's a case of looking at our mid-term time frames to understand where we might be reacting from. So we're mitigating the weekly order block. We've seen a structure shift. Now we have the context because we've already liquidated the monthly low and we can take the long. And this plays out for a 2.6 hour trade. I'm not going to show you the higher time frames, but if you wanted to hold this, you can see how aggressive price then moves. So how to apply this? Always track higher time frame candle closures. So in my case, monthly, weekly, 2 weekly candles. Always map higher time frame points of external and internal liquidity, and I have videos on doing this. We want to know where we're trading from and trading towards, and how our intermediate time frame is going to help us get there. Always mark those sweeps, so raids below candle lows, in line with your bias, and always track your lower time frame price action and wait for your context on one price action to align with your trade ideas on higher time frames. My model is that I track and analyze 32 Forex pairs. I trade gold, silver, Bitcoin as well. And I track 12-hour price action in conjunction with the monthly, 2 weekly, and weekly closes. I'm also looking at things like 3 monthly candles, and I simply wait and execute. Once you get good at this, you can literally analyze over 30 pairs in the market in 10, 15 minutes a day. And it's just about consistency and making sure that you're executing at the exact right times. For more content on how to do price action trading in line with higher time frame candles and to truly trade candle ranges effectively, please follow my channel, subscribe, and I'll see you on the next one.